Welcome to the deep dive. Today, we're going straight to the source, taking a really detailed look at the heartbeat of the American economy.
And we're doing that through one of the most, I think, unique documents out there.
The Federal Reserve's November 2025 Beige book. This is, your shortcut to understanding the economic climate, not just as some big national average.
No, not at all. You get to see it as 12 distinct regional experiences.
Exactly. We aren't here for the dry numbers. We're here for the stories, the qualitative stuff gathered from business owners, community contacts, all across the country.
That's right. And our mission today is explicitly a geographical one. We know the national summary said things were little changed.
Right. Basically flat.
But those averages can be so misleading, so we need to zero in on the contrasts. Find out where economic momentum is actually building, and maybe more importantly, where the friction is.
So comparing districts side by side on things like labor or consumer spending, that sort of thing.
Exactly, to really expose this uneven patchwork we're all operating in.
Okay, so let's set that baseline first. Nationally, the temperature was, well, pretty neutral.
Very neutral. Only one district reported modest growth, and you had two noting a modest decline.
So the broad outlook was stable, but there was this creeping sense of risk, a feeling that things might slow down,
Stability on paper?
but regional volatility right under the surface.
Right. So if you average everything out, you land squarely on that little changed. But the second you look geographically, the difference is just, well, it's immediate. You have these clear growth pockets that were, propping up that national average.
Where were those?
Boston reported activity expanded slightly. Richmond actually grew modestly. And
Yeah.
Chicago, it rose slightly too.
Okay, so some clear bright spots.
But that's where the stability just breaks down. You look at places like New York and Philadelphia,
And what's happening there?
both reporting modest declines in overall activity.
Wow.
And then down in the Dallas district, activity weakened slightly. And this was really broad-based.
Not just one sector.
No, it was hitting non-financial services, retail, banking, pretty much all at once.
Okay, let's unpack those areas that were actively shrinking, because the reasons behind it sound fascinatingly different. You mentioned Philadelphia saw a modest decline.
I did, and the contacts there were very clear. Activity was already trending down.
So it was already weak.
Right. But the recent government shutdown, it acted like an accelerant. It just spurred further disruption.
So in Philly, you're saying policy uncertainty basically pushed an existing weakness into an outright decline.
That is the distinction. It wasn't just some organic weakness. It was policy-induced stress layered on top of what was already, pretty fragile.
And what about Dallas? Was it the same story?
Not quite. In Dallas, the decline was more generalized. It was across everything, from local lending to retail and those non-financial services we talk about.
So like law firms, consulting.
Exactly. And that suggests a much more profound, kind of widespread loss of confidence in that region.
Okay, let's move to the labor market, because here we see a really crucial conflict.
We do. Nationally, employment declined slightly. In most firms, they were reacting very conservatively.
With hiring freezes, right, that's what I saw.
Hiring freezes, letting people leave, and not replacing them. So attrition or replacement only hiring.
So they're clinging to their existing talent.
Yes. Which tells you they see a future need, but they are just terrified of committing to new headcount right now.
So that creates a pretty stark contrast in labor demand, depending on where you are.
A huge contrast. So where are the actual declines happening? We see explicit employment drops in New York, Philadelphia, Boston, Dallas, and Kansas City.
That's 5 districts.
5 out of 12 reporting a slight or modest decline.
But then you have regions that are holding steady or even growing a bit.
Right. Look at Chicago. They actually reported employment increased slightly.
Wow.
And then major districts like San Francisco, Atlanta, St. Louis, Richmond, they all said levels were largely flat.
So the experience of a job seeker in Chicago versus one in Dallas is just, night and day.
Completely different world.
Okay, and here is where we get to the structural change. For me, this was the most insightful part of the whole report.
Technology.
The impact of technology,
Yeah.
yes. Multiple districts, including Boston, and even the national summary itself, mentioned that artificial intelligence was replacing entry-level positions.
Or just making people so much more productive they didn't need to hire.
Exactly. And if you think about that, if you're a recent college grad in a city like Boston, and AI is replacing that first rung on the career ladder, I mean, aren't you looking at a fundamental threat to the whole economic mobility structure?
It's a huge question.
This isn't just cyclical cost cutting. This feels like a permanent reduction in the need for human input at the bottom.
And that reduction in labor demand, it means employers can be cautious about wages.
Mm.
So while overall wages grew modestly, the upward pressure, it wasn't really from salary demands.
So where was it coming from?
It was widespread upward pressure from rising non-salary costs, specifically health insurance premiums.
Ah, so the cost of labor is rising for the company. But the actual purchasing power of the average worker is being compressed by these other rising costs.
You got it. It's a tough spot to be in.
That whole discussion about compressed purchasing power, it leads us right into consumer spending.
It does.
And this is where the story of the bifurcated economy becomes completely inescapable.
Right. Overall, consumer spending declined further nationally, but there's always this one caveat attached to it.
Higher-end retail remained perfectly resilient.
Every time, and this contrast is geographically very acute.
So where is that resilience centered?
Well, New York, for one.
Mm.
High-end retail was strong there, even while overall spending was down. Atlanta and Chicago contacts also noted robust growth, but specifically in segments catering to higher-earning consumers.
So the top income bracket is, for the most part, just ignoring the broader slowdown.
Largely, yes.
Mm-hmm.
Now, contrast that with the pressure points.
The other side of the coin.
Exactly. Philadelphia noted that these pervasive price pressures were really stressing low and middle-income households. And Cleveland reported clear pressure on lower-income consumers. But importantly, they saw the first signs of strain starting to creep into that middle-income group as well.
And in Minneapolis, contacts were just blunt about it.
What do they say?
They said customers in the middle to lower end are definitively tightening the belt.
There it is.
So we have this clear geographical split, but it's really a split based on income. The high-earning hubs are doing fine. The broad middle-market districts are seeing active cutbacks.
And a perfect sort of policy-driven example of this was the decline in electric vehicle sales.
Ah, because of the tax credit.
The expiration of the federal tax credit immediately led to sales drops.
Yeah.
And this was reported across 5 different districts:
Which ones were they?
New York, Cleveland, Atlanta, St. Louis, and Chicago.
It just goes to show you that for a huge portion of the population, those aspirational big-ticket purchases are really dependent on external support.
And that external support, or the lack of it, can become a matter of survival for the lower income segments.
Right. We can't really talk about consumer health without addressing the immediate strain caused by the government shutdown.
We can't. And multiple districts felt this instantly. In Philadelphia, they reported a noticeable pullback in consumer buying in October.
And this was directly linked to SNAP benefit.
Directly. For listeners who don't know, SNAP is the Supplemental Nutrition Assistance Program. It's food assistance. And when those benefits were disrupted, retail spending on essential goods just dried up.
That's a staggering data point. You remove food assistance for just a few weeks, and it immediately creates a noticeable pullback in the broader consumer economy.
It just proves how fragile that financial buffer is for so many households across the country.
And it wasn't an isolated thing in Philly, was it?
Not at all. St. Louis noted the shutdown amplified their general slowdown in demand. Dallas mentioned a pharmacy seeing patients suddenly struggling to afford their medications.
This is economic failure translating into, well, basic human needs.
It is. And the community strain that resulted was nearly universal across almost all the districts: New York, Atlanta, St. Louis, Dallas, San Francisco.
All of them.
Pretty much. Community organizations reported increased demand for food assistance, and they linked it directly to those SNAP disruptions. And Atlanta added a really sobering detail.
What was that?
Low to moderate income households are showing an increasing reliance on debt just to cover typical household expenses.
So they're going into debt for groceries.
That is the financial definition of living paycheck to paycheck, and now, past it.
Okay, shifting gears to the industrial side. We're moving from household fragility to global trade uncertainty.
A different kind of pressure. Manufacturing activity did increase somewhat nationally, but tariffs and tariff uncertainty were cited everywhere as a headwind.
So tariffs are the common pain point, but the performance is still highly localized.
Very localized. We see distinct pockets of strength. New York reported a moderate increase in manufacturing. Dallas remained resilient with modest production growth. Kansas City strengthened slightly, especially in durable goods.
But then you have to look at the areas that are contracting.
Right. Richmond and Philadelphia both decreased modestly. Cleveland declined slightly.
So if tariffs are this universal problem. Why the difference?
It often just comes down to the mix of products and what their end markets are. If you're a durable goods manufacturer in Kansas City, you're riding a bit of a growth wave. But if you're, say, a textile manufacturer in Richmond, you're contracting because your customers are reducing orders specifically because of that tariff uncertainty.
Let's focus on that geographic impact of tariffs for a second. Firms in Philadelphia said, what? That tariffs continue to make our products less competitive.
Right, which speaks to an erosion of their price advantage on the global stage.
And Dallas contacts were clear too. They said tariffs were directly hitting their margins and profitability.
So even if your production is up a little bit, the financial health of your company is being severely compromised by trade policy.
And we have to mention the strange case of Cleveland.
Yes, with the AI data centers.
They got this massive specialized boost from construction of AI data centers, a huge cutting-edge demand.
But even that localized boom wasn't enough to offset the softness in all their other traditional industrial segments.
Which just shows you how soft general manufacturing demand is right now.
It really does.
Okay, turning to real estate. This is maybe the most localized market of all. It's so driven by regional inventory and, of course, mortgage rate sensitivity.
Absolutely. And we see clear residential gains in certain areas.
Yes.
Boston reported home sales showed renewed strength, and contacts there attributed it directly to slightly lower mortgage rates. Chicago saw activity rise slightly, also spurred by those lower rates, and Minneapolis rose modestly.
So there's a clear signal there. Where rates offered even a momentary bit of relief, transaction volume picked up.
Exactly. Now contrast that with Dallas. Weakness continued there, forcing builders to rely heavily on incentives just to move inventory.
And Philadelphia.
Existing home sales continued to decline.
So if you needed incentives to sell a house in Dallas, but Boston was seeing renewed strength, you're really looking at two entirely different recovery paths.
Completely different, yeah, based on regional affordability and inventory.
What about commercial real estate, specifically the office sector? We've heard about the doom loop for years, but are we seeing any regional exceptions to that?
We are, yes. And this is where the phrase flight to quality becomes the key thing to understand.
Meaning the best buildings are doing okay?
Better than okay. The office market is improving, but only for the best space. New York, Boston, and Atlanta all saw positive signs. Vacancies were declining, demand was growing, but, and this is crucial, only for Class A properties.
So tenants are still consolidating, but they're choosing the highest quality buildings.
Right. And the contrast is in places like Minneapolis and Richmond, where office markets are still struggling. In Minneapolis, any improvement they saw actually came from converting office space to other uses.
So not from new office tenants moving in.
No. And in Richmond, that flight to quality leaves all the older Class A, B, and C buildings just sitting vacant.
So the CRE market is effectively shrinking the amount of serviceable inventory.
In a way, yes.
Let's wrap up with the underlying financial pressures on businesses and consumers. Prices rose moderately overall, but firms were reporting widespread input cost pressures. If we distill the regional data, which districts were feeling that squeeze the most?
The pressure was really robust in Cleveland, St. Louis, Dallas, and Minneapolis, and the costs they were citing were remarkably consistent across the entire map.
What were they?
Insurance, utilities, and healthcare costs, rising everywhere. These are sticky, non-cyclical costs that firms just can't easily avoid.
But here's the critical connection for me. Despite those rising input costs, the ability to pass them on the pass-through challenge was severe.
Very severe. In Philadelphia, firms reported a lot of difficulty raising prices.
Why was that?
Because consumers were aggressively searching for discounts. They simply couldn't absorb higher prices.
And in Kansas City, they actually gave a precise number.
They did. Contacts there said most firms were only passing through about 20% of their increased input costs.
20%. So if you're paying 100% more for your insurance, you can only charge the customer 20% more for your product.
You are experiencing massive margin compression.
Which suggests business profitability is suffering even if their top-line revenue is holding steady.
Precisely. And that margin compression leads directly to caution in the banking sector. Loan demand was a mixed bag, but the shared regional trend in credit health, that's our most important leading indicator for future stress.
And what does that indicator tell us?
It tells us that financial stress is rising for the consumer. Delinquencies are rising steadily. St. Louis reported consumer past dues have been steadily increasing, and they expect that trend to continue.
And elsewhere.
Kansas City saw modest increases in consumer loan portfolios. And Dallas reported that overall loan performance deteriorated at a faster pace than in the last survey.
So it's getting worse.
It is. And the banks are reacting to this clear sign of borrower strain. We're seeing tighter underwriting standards in several regions,
Particularly for what kind of lending?
especially for construction lending, places like Atlanta, St. Louis, and Dallas. Banks are becoming actively risk-averse. They're anticipating that the consumer strain we see today is going to translate into broader economic softness tomorrow.
So when we put it all together, what does this all mean? The U.S. economy in November 2025 is, well, it's fundamentally an uneven patchwork defined by income.
I think that's the perfect way to put it.
Higher income consumers are resilient. They're driving localized growth in select regions like Boston and the Class A office market. But the data from nearly every single district, from Minneapolis to Philadelphia, it shows that middle and low-income households are visibly pulling back.
And you see that evidenced by the rising debt reliance and the soaring demand for social services. To summarize the key geographic contrasts, the overall activity is just diverging.
Yeah.
You have Chicago and Richmond managing slight growth, while New York and Dallas contract. The industrial sector is facing this universal pressure from tariffs, squeezing margins everywhere, yet manufacturing strength is somehow localized in regions like Kansas City. And critically, real estate stability is highly localized. You've got rate-sensitive markets like Boston showing renewed strength, contrasting sharply with that continued weakness down in Dallas.
We've tied together a few threads today. We have tariffs that are universally raising the price floor for manufactured goods.
Hmm.
And at the same time, AI is simultaneously reducing the demand for entry-level hiring in key labor markets. This just sets up a profound structural challenge.
It does.
So, here's a final provocative thought for you to take away. If trade policy makes the creation of physical goods permanently more expensive, while technology makes the lowest rungs of the white-collar labor ladder obsolete, what does that resulting dual squeeze mean for the future structure and maybe even the size of the middle class across these diverse geographic regions? Something to explore on your own. Thank you for joining us for this deep dive into the November 2025 Beige book.